Welcome back to our course Research on Corporate Transparency. Today we have David Veenman from the University of Amsterdam with us. And David will be talking about transparency and market efficiency. And this is very fitting because David is a well-renowned expert for everything that relates to accounting and capital markets. So without further ado, David, over to you.
Thank you very much for the introduction and for the opportunity to contribute to this course. I have been given the task of giving a 20-minute presentation on 50 years plus of research. So I'm going to try to talk about a few what I think are important fundamental issues in the field, but also keep in mind that this is a very specific, I discuss very specific topics, and there's much more out there. And many of the things are biased towards some of the things that I've been doing. So let me start by just going back to the lecture that you had on market efficiency, where Joachim talked about the conditions for efficient markets. So either sufficient conditions, which happen to be actually necessary conditions. So there are no trading costs, information is available to all market participants, and investors are rational and have homogeneous beliefs. Yeah, so many of the things I'm going to talk about fall back on these three pillars of market efficiency. But before we start, let me take a step back and think about what determines value for a company. So what determines the value of a company's equity? Yeah, so I went back to my FSA slides and just copied some valuation models. So the dividend discount model on the left-hand side and a free cash flow model, discounted cash flow model on the right-hand side. And these tell us that the value of a firm's equity depends on the expected future cash flow streams that an investor can expect. Yeah, so in an efficient market, this tells us that the value of a company or the stock price of a company should respond to new information, either about future cash flows or about changes in the discount rate. Yeah, and broadly speaking, the goal of corporate transparency is to provide information relevant to both the future cash flows and the discount rate. Yeah, but for now, let's focus on the first component, where we say that information, accounting information, produced by the company should tell us something about the expected future cash flows generated by the firm. Yeah, so that is this link. Now, if we go to the conceptual framework for financial reporting from the IASB, then we also learn that predicting future cash flows is an important objective of high-quality financial reporting. Yeah, it's not the only objective, but from a valuation perspective, the predictive value of accounting information for future cash flows and future dividends is an important fundamental characteristic. Yeah, so the conceptual framework tells us that information is relevant to decision makers and particularly capital providers when it has predictive value of future firm performance. Yeah, so that is important to keep in mind. So within the valuation role of accounting information, an important role is there for the accounting information to tell us something about what's going to happen in the future. Yeah, so going back to this framework where we have the information signal produced by the accounting system that is supposed to tell us something about the expected future cash flows and therefore tell us something about the fundamental value of the firm. What we can say is that the accounting information system produces these types of signals. Yeah, we also know that these signals are not perfect. These signals are imprecise estimates of what will happen in the future simply because the future is uncertain. Yeah, and sometimes the future is more uncertain in some situations or for some specific firms versus other specific firms. Yeah, so we can say these signals are imperfect and they vary in their precision. And what I did is in a very simple theoretical framework, which is much simpler than what you've seen in the previous weeks, given my own limitations. But let's look at a signal that we call X. And that signal is supposed to tell us something about the future cash flows to be generated by the firm in the next years. Now let's say that signal also has some noise in it. Yeah, that's the error term here. And we can say that the noise depends on a certain parameters, and specifically here this variance parameter. Yeah, so we can say this variance parameter it tells us something about the lack of precision in the signal. And the bigger this variance, the lower the precision of the signal produced by the accounting system. And also the lower the correlation becomes between the signal X and the future cash flows to be realized by the company. Yeah, so to give another example, let's say we have two information signals, so signal A and signal B, where the variance of signal A's error term is bigger than that of signal B. And from that, we learned that if investors would behave in a rational way, then they would have to place more weight on signal B because that contains less noise than signal A in reacting to the earnings information or the accounting information more generally. Yeah, so let's say a company produces two signals with an earnings signal and a cash flow signal. Depending on the noise in these signals, investors should allocate weights to these two signals, depending on the noisiness in these signals. Yeah, we can also look at this differently from the perspective of a firm producing one signal versus other stakeholders in the market, like the media or analysts producing other signals, and investors having to weigh all of these different signals. Well, following the Ball and Brown study in 1968, a large part of the literature has focused on earnings as the key output from the accounting system. Yeah, so the examination has been between earnings, the bottom line earnings, and future cash flow expectations, and how that then maps into the value of the firm. Yeah, or how stock prices, changes in stock prices, link to the information in the earnings signal. Yeah, so this has produced a large literature that focused on earnings response coefficients, ERCs, which are nothing more than just the coefficient that we get from a regression of the announcement returns on a measure of the surprise or the news in earnings. And if we go back to the ideal of having an efficient market, then from the basic valuation framework, we know that the ERC should vary predictably with certain parameters. And one parameter is the earnings persistence. So if we say if the earnings are more persistent and tell us more about the expected future cash flows, then obviously this should have stronger valuation implications. Right? So if €1 of earnings maps into an expected earnings of 90 cents in the next year, 90 cents in the next year, then that should have stronger valuation implications than when this would be only 10 cents. Yeah, and the second component is the discount rate. So if we take the discounted value of these expected future cash flows to determine the valuation, then of course higher discount rates should also lead to lower valuations. Yeah. So previous research has shown that these earnings response coefficients vary predictably with earnings persistence. So earnings persistence increases this and decreases with discount rates. But now, interestingly, let's talk about situations where market efficiency is being violated. Yeah, so what happens to market responses to earnings news when, for example, trading is costly, or the acquisition of information is costly, or when investors are not perfectly rational, or they have different beliefs. Yeah, and this is where it becomes more interesting, because of course now we move to the real world situation where things are not perfect. So Ball and Brown already showed this in 1968, where I've produced on the right-hand side here a graph that is from a replication paper by Nichols and Whalen. They sort of extended the Ball and Brown analysis to more recent years. And they basically show the same results, that at time period T, time period 0, where the earnings are announced, we see a pronounced market reaction to the news. Yeah, so good news earnings means higher stock prices. Bad news earnings means negative stock returns. We also see that in the period before the earnings announcement, prices are already gradually incorporating the information, which becomes available through other sources and other information intermediaries. But importantly, we also see that prices keep drifting in the direction of the earnings news. Yeah, so companies with the best positive news, we see that the stock price keeps drifting up in the 60 days, which is approximately 1 quarter after the earnings announcement. And the bad news firms, we see the same pattern. Yeah, so this suggests that the market is not fully efficient in processing the earnings news at the earnings announcement, and it somehow needs more time to adjust to this news. Well, there's a long-standing literature that examines this phenomenon, and the explanations for this can basically be put into 2 buckets. So either irrationality versus rational explanations. Yeah, so we can either say investors are simply stupid, they don't understand this, or there are some other frictions in the market that could explain this type of phenomenon. And I think both explanations have their own merit and they're valid. I think looking at this from the perspective that investors are stupid is probably partially true, but I don't think we learn a lot from that. So I think we can learn much more from looking at explanations that look at other frictions like transaction costs or information acquisition costs. So the literature has looked at these different explanations and did cross-sectional analysis on the factors that drive more of the drift and more or higher or lower earnings response coefficients. What the literature has found is that the higher the transaction costs, typically the lower the ERCs and the greater the drift. Yeah, so when transaction costs are higher, it takes more time for investors to respond to the news and earnings. Another part of the literature has focused on the quality of the accounting system as an explanation. And that part of the literature finds that when the signals produced by the accounting system are more noisy, we see that initially ERCs are lower. And again, the drift is higher. So the market needs more time to respond to the information. Yeah, and that last piece of evidence is consistent with what I showed you in a few slides ago with my simple theoretical model, where we have signals that have some noise. And when that noise is greater, investors initially place lower weights on the signal and simply need more time to update their beliefs in the post-earnings announcement period. Yeah. So again, we can either say that here, these drifts reflect investors just ignoring the information, behavioral biases. But alternatively, we could say that investors simply need more time, more information to actually learn about what the earnings signal actually has to say about firm value. And a related framework that I like to use when thinking about how investors process earnings news is the so-called lagged ERC framework. And again, this is a very simple theoretical depiction of the world. But I think it really helps to think about this issue in a clear way. So let's say there is an earnings announcement, and the earnings news that a company announces is either fully persistent or it's fully transitory. Yeah, so fully persistent means that this earnings news will recur again and again in the future, and fully transitory means that this is just a one-time surprise, and we cannot infer anything from that about the future. Now, let's say that investors assess the probability that the signal is fully persistent as being probability P. Now, let's also assume that the ERC for a persistent earnings signal would be about 10, and the ERC for a transitory signal would be about 1. then rational investors would respond to this by weighting the signals and the probability that the earnings signal is fully persistent. Yeah, so we would get an ERC that would be a weighted average based on these probability assessments. Well, what is important is that typically the earnings announcement is not the only piece of information that is produced by the company or by outside market participants. So what often happens is that other information comes out after the earnings announcement, and investors might update their probability estimates afterwards. And a very simple rearranging of the equations tells us that we can actually depict the market reaction to information events after the earnings announcement, based on the change in the probability estimate, these different ERCs, and the earnings surprise. Well, why is this important? This is important because this simple framework tells us that the stock returns in the period after the earnings announcement can be seen as a function of the surprise or the news in the earnings announcement reported before. Yeah, so the post-earnings announcement returns are a function of the surprise reported earlier. Yeah, and although this does not explain why post-earnings announcement drift is there, it does help us to understand how post-earnings announcement drift materializes, right? How investors update their expectations after earnings are announced. Another reason this is important is that often we see that when there is market inefficiency, when there is predictable variation in future stock returns, we often see that those stock returns concentrate around future earnings announcements. Yeah, so that means that earnings announcements not only provide new information and the market updates its valuation expectations based on that new information, but the market also reassesses the information that was reported previously. So, for example, the previous quarter earnings announcement. Yeah. So, for example, the paper by Sloan shows that a large part of the anomaly, the accrual anomaly, is being materialized in returns at the subsequent earnings announcement. Yeah, when investors update their beliefs about what happened in the previous quarter. So what I also briefly want to talk about is the question of why should we actually care about anomalies, right? So we are in the field of accounting, we're not in finance. So why should we care about returns being predictable in the future? Well, from a finance or asset pricing perspective, right, we could be interested in updating market models or just trying to come up with an implementable trading strategy. Yeah, but from our perspective, this is probably not so interesting. From an accounting perspective, we can learn from market anomalies because they help us to understand how to resolve frictions that exist in the market that prevent prices from fully reflecting the information and to level the playing field among different investors. Yeah? And to give you one example, I've worked in the anomaly area as well. And the setting that we examined is not so important for our discussion here. But what is interesting in our paper is that we uncovered predictable returns spreads of around 1% around earnings announcements. Yeah, so theoretically, you could think, well, if I can continuously trade on the information that is predictable at the earnings announcement, I can make large returns over time. But actually, we argue that these returns, even though they're 1% in just a few days, are not tradable simply because the costs of trading around earnings announcements are relatively high, and well-informed arbitrageurs will likely not trade on that because they will only trade until the benefits of doing so exceed the costs of doing so. So then again, the question is, why do we care? Well, we care because in our paper we show that this earnings surprise game that we focus on leads to an unlevel playing field because some sophisticated investors are able to profit against the less sophisticated investors on a continuous, persistent basis. Yeah. So again, from an accounting perspective, we care about how information can actually level the playing field. So finding that information is not fully reflected in prices can inform us from a regulatory perspective. Okay, then let me talk about one of the papers that was assigned. This was on non-GAAP earnings. And what we basically see is that more and more companies are reporting performance metrics that deviate from the official numbers that are supposed to be produced by IFRS or US GAAP. And these are supplemental disclosures. Yeah, so companies don't have to provide them, but companies do provide them in addition to the official numbers. And the big question is, why do companies do this? And we also see that investors and analysts often ignore the official numbers and only focus on the adjusted numbers. Well, here's an example. I will not focus on this in detail, but what is important to keep in mind is that companies typically exclude expenses when coming up with an alternative earnings metric. So they either exclude items like goodwill impairments, which are one-time items, or sometimes they exclude recurring expenses like stock-based compensation. Well, again, going back to the valuation framework, we can say when it comes to goodwill impairments that it probably makes sense to exclude these because they are one-time items, or at least they're supposed to be one-time items. So tell us less about expected future cash flows. Yeah, so that means including the goodwill impairments from a valuation perspective would introduce, again, noise, and this would reduce the predicted value of the earnings signal for future cash flows. Well, then there are some items like stock-based compensation or the accounting for intangible assets, which companies and some analysts argue are not relevant either from a valuation perspective. And also the argument is here that these introduce noise into the earnings number and therefore, again, make the earnings number less predictive of future performance. Yeah, so in that framework, it could be that companies try to inform us by taking out these noisy components from earnings and provide us with an alternative metric that is more useful from a valuation perspective. On the other hand, the big tension in this literature is that because companies always exclude expenses, the resulting number is always higher than the official numbers. So it could also be that these companies are just trying to mislead us. Well, what we did in our paper is we focused on the non-GAAP reporting in loss-making US companies. And one of the motivations was that we saw a lot of companies that were actually loss-making, but reported a profit based on adjusted non-GAAP numbers. And many of these companies also did so by excluding recurring expenses like stock-based compensation, as opposed to the one-time items like impairments. Well, why do we focus on loss firms? One reason was that we saw many of these companies simultaneously reported non-GAAP profits. Some other motivations were that losses tend to be less persistent than profits. Yeah, so we can say there's more noise when it comes to forecasting future cash flows. Greater uncertainty, and these companies are typically represented by a poorer information environment, so there's more need for additional disclosures that resolve the uncertainty. And so our basic research question was, how precise are these GAAP and non-GAAP numbers when it comes to making assessments of future cash flows? Yeah, from the perspective of evaluation of the firm. Well, these are the main results. So I reproduced the table here, but let me focus on this slide here, where again we go back to the framework where we say that earnings are supposed to say something about future cash flows, and that tells us something about valuation of the firm. What we find on average is that for the companies that we examine, GAAP earnings appear to be very uninformative about future cash flows or future earnings, future operating earnings. We've used several dependent variables there. And in contrast, the non-GAAP earnings for these firms tend to be very informative, or very predictive of future performance. Yeah, so we find for these companies that they seem to be reporting these non-GAAP numbers because the numbers produced by the accounting system are so noisy that they lead to a very weak relation between the official numbers and future performance outcomes. Of course, given this link that we find here, the next question is, what is the link with valuation? So how does the stock market value this information? Well, actually, when we focus on ERCs based on non-GAAP earnings versus GAAP earnings, we find that the relations with stock prices are very similar to the relations we uncovered for the future cash flows. What does this mean? Well, this means that the market actually sees through these disclosures that managers provide. The market sees that the non-GAAP earnings have better signaling value for future performance than the official GAAP numbers. And the weights that investors place on these signals is according to their predictive value. Yeah, so we find that the ERC here for non-GAAP earnings is much bigger than the ERC for the GAAP earnings. Yeah, so again, this suggests that the accounting system produces signals that are not perfect, and they vary in their precision. And so that also means that if we go back to a Grossman-Stiglitz type of world, that then financial analysis actually could be helpful. Yeah, and disaggregating the financial statements based on different expenses that might have different information content can help us to make better assessments of future performance. Yeah, so this suggests that information acquisition costs might be non-zero because we might have to dig into the numbers to derive our own private information. Well, the good news here is that actually company managers are providing that information to us. They respond by providing supplemental disclosures of these non-GAAP earnings that help us to make more precise estimates of future performance. Here I produced some recent insights. So if you're interested in this, please have a look at these references. I've posted in the final slide some of these references for you to look at. So then the final part of this presentation focuses on investor types. Yeah, so we haven't really talked about the fact yet that some investors have better information than other investors. Yeah, so in the theoretical papers assigned to this module, we actually learned that investors vary in terms of their information endowments. Yeah, and typically what we assume in the literature is that larger institutional investors typically have better information and they're more sophisticated than retail investors. And I think this is very important from a fundamental perspective for the development of the literature. But I think this is extremely important now and very timely now, given the surge in retail investment throughout the world. So I think there are a lot of important developments and opportunities to examine the role of retail investors in markets and how retail investors process accounting information. Yeah, so here I also produced a few references related to very recent papers that examine these issues. So if you're interested, also have a look at those. So then, related to this, right, given the fact that we know that there are different types of investors, this has led to important theoretical developments in the literature that actually suggest that information does not only just flow into prices because there's information about future cash flows, but the mechanisms are much more complex and depend on the market microstructure. Yeah, so the O'Hara paper suggests that when information is asymmetric among market participants, then uninformed investors typically demand a compensation for the risk that they bear from holding a bad portfolio because they're trading against informed investors. Yeah, and I have here a quote from the O'Hara paper that says, incorporating price discovery in the asset pricing literature helps explain why certain factors like the microstructure of where a stock trades, but also the firm's accounting treatment of earnings and other operating information, and its disclosure policy affect the returns that investors demand in an equilibrium. Yeah, and now I've really butchered the theory here because this is much more complex, but I try to depict this as simply as possible based on my understanding, is that here we have information, and we can say, based on these theoretical models, that information affects liquidity, and therefore this affects price through the discount rate. Yeah, assuming that differences in liquidity are priced in the market. Well, that brings me to the final reading of this module, which is the Balakrishnan et al. Paper, that focuses on the question of whether managers can actually influence the liquidity of their company stock by changing the information environment. Yeah, so the answer to that question is yes. So they show that managers can actually shape liquidity through disclosure choices. But what is important here is to recognize that to examine this question, we have the problem that disclosure is an endogenous choice by managers. And therefore, what they do is they focus on a setting where there's an exogenous shock to the information environment of companies. And specifically, they focus on the loss of analyst coverage, which has been shown to lead to increased information asymmetry among investors, and therefore lower liquidity and drops in the stock price. And then they ask the question, well, after this shock, what happens to the liquidity of firms? And what is the role of managers? What is the role of disclosure? So what do they find? So first of all, they find that after 1 quarter, after the shock, there's a reversal in this liquidity shock, but only for companies that respond by increasing the quantity and quality of their disclosures. For companies that do not do so, they find no reversal in the liquidity effects, and these companies actually have persistently worse liquidity. Yeah, the final thing that they find is that based on the types of analysts that companies lose, so analysts that cater to retail investors versus institutional investors, they conclude that voluntary disclosure is primarily aimed at reducing information asymmetries between retail investors and institutional investors. Yeah, so the important conclusion here is that disclosure can have a causal effect on liquidity and the cost of capital by leveling the playing field between different types of investors and reducing information asymmetry. Yeah, so then back to the first slide, back to market efficiency. So a very brief summary of what I talked about. So accounting and transparency matter for market efficiency because they help investors make more precise predictions of future cash flows and better assess firm value, reduce information acquisition costs and speed up the price discovery process, and improve liquidity by reducing information asymmetry among investors. Yeah, and like I said before, this is a very specific, a small summary of things that have been done in the literature, and I'm missing a lot of points here, but still I hope this was useful. And I probably went over time, big time.
Hey, thank you, David. And no problem. It was great listening to you. So I think we all learned a lot. So you can stop sharing your screen now so that we can enter into the discussion maybe. So yeah, first of all, thanks again. That was extremely well done. Now we have a bunch of questions that you guys sent in. And like always, we will structure the questions that we start a little bit talking about the Lung and Veenman paper that you presented, and then we move on to somewhat more general questions, if that's okay. And yeah, so feel free to talk about or answer the questions broadly, also to share your views on general topics. So the list of questions will be kicked off by Ariana. Ariana, please.
Yes, hi everyone, and thank you again for the presentation. It was indeed very useful and helpful. So yes, while reading your paper, I had a question regarding the general definition of non-GAAP earnings. that in partly you already addressed in your presentation. So I was wondering what is the discriminant to distinguish between non-GAAP versus GAAP? And also if we can consider the source of the information as a discriminant. So for example, Twitter earning announcements or press releases, can this sort of disclosure can be considered non-GAAP, or is more on the computational side of the measure that we refer to?
Yeah. Okay. So thank you for your question. That's a very good question. So it's primarily the computational side, and the non-GAAP definition is actually not something that is formalized. I would say it's more something that developed both in the academic literature, but also the way that companies labeled these numbers. And non-GAAP just basically refers to ways in which companies calculate the bottom line earnings performance in a different way. Yeah, so by saying, well, these particular expenses are not so useful, so we simply ignore them. And that's different from saying, well, we completely change the way we make our estimates, right? So let's say a company follows a certain accounting rule, and it needs to be very conservative in making estimates of an allowance, right? And then that would be according to accounting rules. And then the company says, well, we don't agree with the way this is calculated, so we calculate the allowance in a different way. So that's not something that commonly happens. Yeah, so it's not that companies change the way they estimate certain things that are required by the rules, but it's more that they just completely ignore particular line items that enter the calculation of the earnings number. Yeah. So and what is important to also keep in mind is that especially if you look at the US setting, then these numbers are supplemental numbers provided in press releases, in addition to the official number. So companies are required to first report the GAAP number, and they cannot give more prominence to the non-GAAP numbers. And then later on, they need to reconcile the non-GAAP number to the closest official GAAP number, which is typically the earnings number. Yeah. So there are some people that also refer to anti-GAAP numbers, and that would be slightly different, because that would just be basically the company inventing their own accounting rules and coming up with numbers that are not defined within GAAP. Yeah. So with non-GAAP earnings, the numbers are defined within GAAP. It's just that the company says, well, let's see what happens to the bottom line number if we exclude these and these items.
Thank you. It's very clear now. Thanks.
Okay.
Perfect. So the next question is going to be asked by Mirab Sohail. Mirab, please unmute yourself and ask the question if you want.
Hi. Thank you for the presentation. My question is that, in your paper, you say that non-GAAP disclosure are more informative than GAAP, but how can we compare them? Because the purpose of GAAP standards is to provide consistency and comparability of financial information about all the firms, like kind of benchmarking them. Whereas the non-GAAP disclosure by firms, it reduces the information asymmetry.
Yeah, that's a very good point. So when I started with this slide with the conceptual framework, right, I focused on one particular objective of financial reporting. And what we do in our paper is we really focus on the valuation perspective. And of course, there are many more objectives of financial reporting, including, for example, comparability. Yeah, so it's important to keep in mind that in our paper, we purely focus on this valuation perspective that suggests that the number should be more informative about future performance outcomes. Yeah, but that might indeed go at the expense of comparability. What is interesting is that there's recent work that actually shows that even though companies exclude certain items, this can actually increase the comparability across firms. So that would mean that both the evaluation objective would be achieved and the comparability would also be improved.
Okay, thank you so much.
Yeah, you're welcome.
Yeah, so thank you for this. And also, I have a follow-up question that I'm asking on behalf of Blessing Oinlola, who I think has said that she wants me or he wants me to ask the question on her behalf. So this is, but these two questions are actually related. It's about whether non-GAAP measures actually can be stated now to be a better source of information generally defined based on what you do in your analysis. So could you make this point as a general remark, or is maybe what you state more limited in nature?
Yeah. So what we state is limited, especially to the fact that we focus on a subset of firms, the loss-making firms, where we also find that the non-GAAP numbers, the incremental information in non-GAAP numbers is bigger than when we focus on profitable firms. Mm-hmm. Yeah. So for profitable firms, we actually find that this incremental information is significantly less, and there's also more evidence that companies also use this maybe in an opportunistic way. And to give some background also is that when entering this project, we actually had the prior that companies were doing this to mislead investors, that all of these loss-making firms were reporting profits just to pretend like they're profitable firms. But the results actually pointed completely in the opposite direction. But of course, these are average effects, right? So we find that for this particular sample of firms, there is a big difference between in the predictive value of the non-GAAP earnings versus the GAAP earnings. Yeah, so I would be relatively confident in concluding that for these loss-making companies, that the non-GAAP earnings are more informative than the GAAP numbers. Yeah, but more generally, I would not say that. Right? That there the differences in general, including profitable companies, are much less dramatic.
If I would like to annoy you a little bit, I could maybe also argue that more informative can easily be misunderstood as better, meaning more desirable from a regulatory standpoint. And I think this is a conclusion. Yeah, if I would draw this conclusion, what would you say? I'm the regulator and say, okay, yeah. David has shown me that this is the better measure, so I should now impose that measure.
Yeah, so that relates to the earlier question, and right, it completely depends on what your objective is of the financial reporting, right? So again, we focus on the valuation role of financial reporting, but we also have a stewardship role, and we simply, for example, if we focus on stock-based compensation expense, which is a real expense to firms, then we actually conclude that for these types of companies, this stock-based compensation expense is not very informative about future performance realizations. But still, this is important to tell the stakeholders that there's a huge amount of stock-based compensation being paid to the employees, right? So it completely depends on the perspective you take on the objective of the financial reporting. Again, we focus just from the valuation perspective, and there we conclude that the numbers are less informative if we take this stock-based compensation into account. But of course, we should not ignore the expense from other perspective to inform stakeholders.
Yeah, very good, thanks. So also, I supposed to ask a question on behalf of Caro Walz, because she has a little bit of a shaky internet connection, she said. And this is a question that is related to tax loss carry forwards. So I'm reading this question out because it's somewhat longer, and I want to make sure that I give it full credit because I'm not a tax expert. Okay, so Kawa was wondering if, especially when we consider loss-making firms, the usefulness of non-GAAP profits for the assessment of future profitability could also be used by investors in order to assess the value relevance of deferred tax assets or tax loss carry forwards. And whether for companies with a history of losses, non-GAAP profits could be a recognition criteria under, for example, IFRS for a deferred tax asset in that case. Because I came across literature that stated a high explanatory power for deferred tax assets for future tax payments, but regardless, a low value relevance for investors since they consider them as some kind of black box. I'm assuming that means the investors simply don't get it, and this is why they don't price it.
Yeah, I think in the end, so what we show is that these companies that are loss-making and they additionally report non-GAAP earnings measures are actually more likely to return or become profitable in the next years. Yeah, so in that sense, I think we would be able to say that as a signal to investors, right, these disclosures could actually be helpful in assessing the probability that the company will become profitable in the future. So from a deferred tax losses and tax loss carry forwards, I think this would be informative. Yeah, whether right, this would be something that would help recognize things officially in the regulation. I think that was also part of the question, right? So the recognition criteria, that would be a bit more shaky, of course, because we're now relying on numbers that deviate from GAAP, which I think would be difficult to justify as an input to GAAP or IFRS. Yeah.
Okay. Thanks a lot. Now I'm handing over to Tobias for the next question. Tobias, please, over to you.
Yeah. Hi, David. Thanks for your presentation and discussion. I feel it's very interesting. I have a bit of a broader or bigger picture question. So I really like your paper and it's a good read. And there's now in the literature also broader evidence that we are slowly moving to a balance sheet approach that makes accounting numbers less useful. And there's also evidence or studies on different fields of accounting, like lease accounting, pension accounting, human capital accounting, that might say, okay, hey, maybe accounting is not that relevant anymore with moving to a different underlying regime. My question would be, do you see a link between this move towards the balance sheet approach or leaving out certain fields accounting does not account for, or accounting standards and the use of non-GAAP measures? And what's your opinion on this? And what's the bigger picture you see behind it?
Yeah. So I definitely think that there's a link, right, with the recent development. So if you, for example, read some of the recent work of Baruch Lev, right, who says that accounting, what does he say? Accounting is the end of accounting, right? So accounting is no longer able to capture the intangible assets of companies. Then there's definitely a link, because the expenses that we found were excluded, like stock-based compensation and intangible amortization, all relate to these difficult to measure intangible assets. So I do definitely see that link. In terms of the balance sheet approach, right? So I saw that in your question, you also refer to the other comprehensive income items that relate to that, right? So what is interesting is that companies do exclude one-time items like fair value adjustments that go up and down from period to period, but they're not as frequently excluded. At least that's from my looking at our specific sample of companies as these other more recurring items. And so again, this refers to the difference between the recurring expenses that are being excluded. like stock-based compensation and intangible amortization, versus the one-time items like fair value gains and losses. Yeah. So I hope that's in the direction of your.
Yeah, it does. That's very interesting. Thanks.
And to follow up, so one more thing is that, right, this also really relates to the valuation perspective, right? So other comprehensive income items do not flow through the income statement because they make the earnings number less persistent and less predictive of future performance. And then from a valuation perspective, it also becomes the earnings number becomes less useful, even though again these expenses might be very informative for other reasons.
Thanks.
Nice. Okay, so now we have two questions that are a little bit more related to technicalities in your paper, and these questions will be asked by Leon. Leon, please. You're muted. Leon, you have to unmute yourself.
Sorry. Hi, David. After reading your paper, I have two questions, and they are similar to previous questions. And the first one is, why do GAAP losses highly predict future cash flows for GAAP-only loss firms, while the predict power of GAAP losses for non-GAAP loss firms is dramatically reduced? And I mean, the gap for both sets of firms should be the same, but the predict power is quite different. So what's the intuition behind that?
Yeah, that's a good question. So first of all, let me start by saying that I think that's what I read from your question also, is that it is important to realize that the GAAP number is the primitive number. That's the starting point. And given that has relatively limited information value, this is why companies add the non-GAAP number that makes certain adjustments. And so the baseline is that the GAAP number is not very informative. But what is important to say in our paper is that we don't have a specific intuition as to why this one group of loss-making firms versus the other has a different informativeness of the GAAP earnings number.
Yeah.
So we don't have an intuition for that. The only reason why we split those two groups of companies is that the one was so dramatic in the sense that the GAAP losses were actually converted into a GAAP profit, a non-GAAP profit, that we just believe that these were useful to examine separately. But again, we didn't have a specific prediction that for these companies, the GAAP earnings would be even less informative than for loss-making companies in general.
Okay.
Yeah.
Yeah.
You had a second question, right?
Yeah. My second question is, in the paper also, the GAAP earning is equal to non-GAAP earnings plus exclusions. So why you said the GAAP earnings are less informative than non-GAAP earnings?
Oh yeah, so sorry. I think I tried to answer your second question before. So I was mixing these up. Sorry for that. So what is important is that we cannot really say that the GAAP earnings are less informative than the non-GAAP earnings. It's more that the non-GAAP earnings are more informative than the GAAP earnings. Yeah, so again, the baseline is that companies report GAAP earnings, and then they make adjustments to the calculation of the GAAP earnings to produce a non-GAAP number, and that number is more informative or more predictive than the GAAP number. So we don't really argue that the GAAP earnings become less informative than the non-GAAP earnings, because the non-GAAP earnings is not the starting point, but it's really the GAAP earnings that are less informative. And that again is because the GAAP earnings are composed of different items, right? And some items introduce more noise into the bottom line performance metric than other items. And by taking out the items that have more noise, we produce a bottom line number that is relatively more predictive of future performance.
Yeah, but like this is also hold for sophisticated investors, because sophisticated investors, they know maybe more than an uninformed investors, like unsophisticated investors, and they know what does this item really mean for the calculation of future cash flows of the firm.
Yeah, so your argument would be that, well, let's say we have an income statement and we have all the line items, then as a sophisticated investor, we would be able to reproduce this adjusted number ourselves.
Mm-hmm.
Right?
Yeah, and without biasness from the managers of this firm. I mean.
Yeah. So that's an important point. What we find is that actually that is typically not sufficient. So what we do is we actually compare companies that do report these non-GAAP earnings with companies that don't, but do have the same line items on average. Right, so we match companies based on the level of their stock-based compensation, and we find that the companies that do report non-GAAP earnings have lower GAAP earnings informativeness. So there's more incremental information in the non-GAAP earnings. Yeah, so that suggests that investors would not be able to just mechanically produce a similar earnings measure, and that's the signal that we get from managers who know more about the information value in these line items, is actually informative. And one thing I need to add also is that in practice, not all these line items are actually available, right? So we don't have the income statement fully disaggregated in every period for investors to actually reproduce these numbers. Yeah, so for example, the intangible amortization is only there if companies exclude them from the GAAP earnings number.
Mm-hmm.
Right. Sorry. Yeah. Sorry, you had a quick follow-up, but then I would like to move on.
Okay.
Or are you okay?
Yeah, it's okay. Thanks.
Thank
Perfect.
you.
Sorry, I didn't want to shut you up, but the time is running, right? So we have some other questions also on the list that I would like to go into. So next would be Ulrich Atz. Ulrich, over to you.
There.
I love the question.
Yeah, nice to meet you again. I think we met last fall at NYU.
Yeah.
It's hard to be sure with all these Zoom meetings, but
Yeah, that's correct. Yeah.
So I noticed that you report and you run a couple of sensitivity analysis, which I find very commendable because they give a better interpretation. And I was wondering if you sort of produced them from the very beginning, or if this was more something that was asked by the reviewer, or you added at a stage because you want to be more certain in your results. And maybe from a practical point, then, new things come out every year. So is this something you would recommend being up to date, or are there what's your recommendation in how to do them?
Yeah, that's a very good question. So what we had in the review process is indeed the reviewer at some point saying, hey, non-GAAP reporting is a choice. Oh, the lights are now turning off in my room. I think I didn't move for too long. So non-GAAP reporting is a choice by firm managers. So you have an endogeneity problem, period. That was what the reviewer said, without telling us what precisely that problem was. And we did recognize that indeed this might be an issue. But of course, when talking about an endogeneity problem, we first have to think about what is actually the economic problem here that causes the endogeneity problem. So we thought about that very long. And then decided to just use standard measures to solve this problem. But what I think is important is that when responding to such a comment, we always have to keep in mind that we can never perfectly solve the problem. Yeah, so we can do whatever we want econometrically, but we will never solve the endogeneity problem. So to come back to your question, right? Why did we use these specific types of approaches, like the Rosenbaum bounds, right? That's what you're referring to.
Yes.
Is that we wanted to make more salient just how big of an issue the endogeneity problem was, right? So we recognized that we can never perfectly solve the problem, but what is nice about these specific methods that you are referring to is that they show us how big of a problem the endogeneity problem should be. So how big the correlation of the omitted variable should be to make all of our results go away. Yeah, so the reason we use these methods is not to just solve the endogeneity problem, but just inform the reader about how big of a problem this might be. And ultimately, it's then up to the reader to argue that this is indeed a big problem. We concluded that for our setting, probably the problem is not that severe. But yeah, someone else could disagree with that. And I think it's important to be transparent about that, to actually stimulate discussion rather than just saying, hey, we checked the box and there's no endogeneity anymore, because that's not possible.
Thanks.
Yeah. Needless to say, I'm a big fan of this. No, but this is something that, also David and I, we talk a lot about, how to make research more informative, more transparent. And I'm also not a big fan of just, shooting the endogeneity gun at papers without thinking about what this means economically. And I think Rosenbaum bounds are a very smart idea in order to assess how severe the issue actually might be. So I really hope that we see this more in the future going forward. And I know that sometimes, our field tends to be a little bit, let's say, conservative when it comes to certain tools. But I think here, this is really something that I hope that it will develop traction in the future going forward. So thank you for that, David. Okay, so now we move on to questions that are a little bit more general in nature. And there is a first question by Usha on another paper actually that you wrote in Management Science. And I contacted Usha and said that, feel free to ask the question, but also keep in mind that not everybody has read all of David's papers. So I don't know why, but that happens. So please, Usha, over to you.
Thanks. Hi, David. Thanks for the presentation. I wanted to take this opportunity to ask a question about the hypothesis development section of your management science paper. So in your paper, you discuss that and highlight actually prior literature that says that firms that have incentives to meet analyst forecast benchmark, they have incentives to influence analyst forecast downwards. And similarly, also highlight prior literature that also says that analysts have incentives to follow management cues, and they also put a downward bias in their forecasts. But then you bring on the discussion on to this say that there is a negative relation between analyst dispersion and firms' propensity to meet earnings expectations. But what I fail to understand the connection is like, then how, intuitively firm expectations management should either lower forecasts. That is, if the analysts are predicting something, firms have their incentives to bring my analyst forecasts downwards. But on the other hand, you say that analyst dispersion increases, forecast dispersion. So does that mean that some of the analysts don't follow management cues and they don't lower their forecasts? Because I don't get it how dispersion increases.
So I actually think we say that dispersion decreases. Right? So the point of that paper is that basically prior research has looked at the link between analyst forecast dispersion and stock returns, and we try to explain that using the earnings expectations game. And what we say is that when companies guide analyst forecasts downwards, that leads to both lower dispersion and a higher likelihood that the company will meet or beat expectations. And that's sort of the mechanism that we propose in explaining this link between dispersion and stock returns around earnings announcements. But what is important is that we argue that the dispersion decreases as a result of this game. Does that clarify?
Okay. Yeah. Okay. Thank you.
Thank you, Rusha. So now I'm bundling together two questions, which don't sound related, but I think they are related. So that's the question by David Ugudugu. So David, you wanted me to ask the question, right? So, and the other would be the question, asked by Rebecca. So David had a question about other markets, so non-US markets, given that we have a lot of evidence on the, let's say, on the market efficiency of US markets and how prices unravel on US markets, but relatively little evidence on, let's say, non-US markets. And Rebecca brought up a point that I believe is very interesting. And this was about alternative trading facilities, so other markets, meaning, for example, she gave examples like the Chi-X and BATS and ECNS and ATS, the latter two I don't even know, but I know that there are several trading platforms out there that generate liquidity and also maybe facilitate price discovery. So if I bundle these questions together aggressively, and the original offers can feel free to chime in and correct me, I have this feeling that this could be interesting to look at how price discovery varies across markets, maybe. But David, what do you think?
Yeah, so let me start by answering the second question. So I think I must say that I'm not an expert in these alternative markets. I do know that there's a recent paper, I think it's in the list of references that I provided, that focuses on dark pools. Okay, so also alternative trading venues, and that specifically focuses on price discovery in these markets related to earnings news. So I think there's definitely new research streams looking at that, but I'm really not an expert in this field, so I cannot talk about the details. If we talk about the first question, I think that's a very important and relevant one, in the sense that all of this literature is primarily focused on the US, and not only in terms of the markets, but also in terms of the disclosures of companies. And many of the questions that are being examined in the literature might not be context specific. Yeah, so in that sense, if a question does not specifically relate to a particular institutional setting, then my suggestion would be to focus on the setting that gives us the best laboratory experiments. And the data in the US is so rich that oftentimes this is why myself included also focus on the US setting, because it helps to more easily examine specific, or it gives a better laboratory setting. And what is particularly, or what is one of my frustrations when it comes to European data, is that in contrast to the US, in Europe, we don't have one central repository for where companies provide their financial reports and disclosures, right? So we are moving to electronic reporting, XBRL, but still all the reporting happens, all the filing of the information happens at the country level, at different types of repositories, different languages even. So it's very hard to, for example, do our study, our non-GAAP study in a European setting. It would require much more effort to gather all the disclosures and to parse the disclosures to do a similar type of study. Yeah, so my hope is really that to improve the research on European settings, which could be a very interesting laboratory experiment setting as well. We would move in the next decade or two to like an SEC EDGAR system, but then in Europe, organized by ESMA or so. Yeah, that would be, from a data nerd perspective, like myself, that would be really helpful, but also from a research perspective.
By the way, quick note, this is to some extent on the TRR's to-do list to help facilitate at least that the data is then being collected and pre-processed and so on. Yeah. Not sure whether we are able to pull this off, but we're looking into this.
Very good.
And another thing, another remark, if I may, real quickly, about the motivational part for non-US studies. So I think it's always good to think about the questions, what makes the European setting or the non-US setting unique in a way that we can learn something that generalizes across the specific country setting. And sometimes it's the market microstructure of a given country, for example. So the given market has a slightly different way of trading, or that the market has a different way of developing and providing information. And all of this can make the research actually very interesting. But if you just produce a study that says, okay, same question, other data, then of course, obviously, it's a little bit harder to get this published, let's say, in a very strong journal, because then, what is the additional contribution question comes up. Okay, so now we are already running a little bit out of time, but there are 2 questions from the list that I still would like to ponder on, so David to ponder on. And the first would be asked by Kathy, and the second would be asked by Jeremiah. So David, for you to get an idea, there will be question 11 and question 13. And I apologize to everybody who is not getting his or her chance to ask the question. I'm sorry about this, but feel free to reach out afterwards, maybe to David directly. He would love it. No, David, I'm not sure whether you would love it, but you can comment on this. So, Kathy, please.
Yes, thank you. First of all, thank you for the very interesting presentation. And my question is actually based on the market efficiency theory. So the theory was actually based on many rigid assumptions. From my point of view, I think many of them are highly unlikely to fail in the reality. For example, the investors' beliefs are more heterogeneous than being homogeneous, which you also mentioned in your presentation. And then another one is the price is not always represent the actual information. Sometimes they can be manipulated. So my question is, what makes the market efficient theory important, and how could we actually apply it to the real life? Also, during my study and research, I found out there are many debates regarding this, especially on the relevance and validity of this series. So I would like to know what's your opinion regarding this.
Yeah, so that's a very good question. So despite the fact that this theory has been contested for a very long time, right? A few years ago, Eugene Fama still got the Nobel Prize for it. So yeah, apparently it does have some merit, apparently. And I mean, I agree with that, because what is important, and I think even Eugene Fama recognizes this, is that the efficient markets theory is a starting point of thinking about how information is aggregated into prices and into markets, right? And there's a lot of evidence that the fundamental assumptions underlying this hypothesis do not hold in practice. Right? But as we saw in the discussion and in the slides before, is that still by thinking about these fundamental assumptions, they help us to really think about why are there deviations from this ideal of efficient markets, and how can we get a little closer to markets and prices capturing information in a slightly better way. And also what is important is that the model or the theory is so relatively straightforward that it's much easier to fall back on than alternative models or theories that have been developed, because there's no real good alternative available, or a simple alternative available to the efficient markets theory that helps us in a very simple way try to understand the phenomenon that we observe, right? So the answer to my question is that even though we know that the fundamental assumptions are frequently violated, still the model or the hypothesis helps us to provide a framework to understand why we see these violations. That would be my answer.
Thanks a lot. So Jeremiah, you get the honor of asking the last question today.
Yeah, I hope it's not too much out of left field, but I found the O'Hara paper really quite interesting, and tried to map it onto sort of today's world and think about, okay, where do we have these dumb investors, and what does that look like? And having, being American, I've got sort of my ETFs, and I would like to think that my ETFs, maybe, I'm not going to get I'm not a stock picker. I have a broad-based index fund, but I would like to think that I'm at least a benign influence in the world. Thinking about the O'Hara paper, where essentially, yeah, fine, I'm not going to get the best returns, but I will get better returns than any sort of option, say, if I would invest in bonds. But then I started thinking about, okay, but what are the other ways in which my investment is sort of active? And so then to fill out the story, so we say we have climate change, and we have technological change that is trying to address climate change. And then effectively, I am contributing as an index fund investor to a misallocation of resources. So firms that are less optimal are being funded by me, the smart investors, the smart money is going towards, say, CO2 neutral solutions. But there are actually direct welfare. I may benefit sort of on the margin, but there are welfare impacts to the world from the dumb money sitting on ExxonMobil. And I was wondering whether that was sort of a little bit too far-fetched, or whether sort of there's a dynamic that you also see in the O'Hara paper.
Well, I mean, I must say I haven't thought this through completely. But of course, these are important developments, and the O'Hara model is purely focused on the financial payoffs, right, of investing, and the price protection that investors seek when they're not informed. But I'm not aware of the developments theoretically in the field. But of course, you can adjust these models to make investors have different utility functions, right? So utility doesn't have to come completely from monetary gains, but also just from personal utility from investing in greener companies.
Well, I thought that the little sort of turn of the screw is, if you look at the price protection that that the dumb money is demanding, maybe that's actually coming from excess externalities. So we're burning that last ton of coal cheaply, quickly, keep the index investor happy. I don't know. I mean, it's too extravagant, but
Yeah. No, again, I'm not aware of these specific developments in the literature, but I would be surprised if there are no theoretical developments that try to understand investment behavior and microstructure and asset pricing, including utility functions that take this into consideration.
Yeah, I can chime in a little bit on this one. So because I found this a nice question. So I also thought about this a little bit, and similar to David, I'm not an expert in the field of multiple objective finance. That's something that you can actually also think about and Google about. But even without this idea of multiple objectives, I think you have a point with this, dumb money argument. So let's assume that, the average investor is just unable to build expectations on the long-term benefits of green investment. Yeah, so we simply don't get it. We don't get it that in 50 years this will really pay off. Yeah, instead we are too myopic, we are too short-sighted, and so. But we are inherently insecure about this because we don't know, right? So then us being uninformed, or a large part of the market being uninformed and insecure about this future payoffs, can of course increase the cost of financing for the whole market, and in particular also for those firms that have a high factor loading on this type of investments. So this is a problem. And then, of course, the question is then about, what will happen when you have only a small subset of the market that is actually informed, and this is not the typical subset that has low transaction costs. Because the normal argument of the financial market is, the well-informed people are those that have the lowest transaction costs and the best arbitrage opportunities, so they will move this new information into the market quickly. But now let's assume that in this case, the green investment people actually don't have low transaction costs because they have little resources, not that much asset under management, so they can't really move the price. And this would make your problem even more severe. Yeah, but this is an argument that is not based on maybe different objectives and another thing that needs to be priced, but simply on, very traditional estimation risk arguments. But really interesting to ponder on, right? So I liked it. Perfect.
Right.
David, any last views or ideas that you want to share?
No, I don't think so. I think we're way over time already. But
yeah, we are
just
over time.
Thank you for your attention and your questions. This was very nice. I hope this was useful for you as well.
It was useful for me. I learned something, so that's helpful. No, but I think, everybody feel free to chime in and give a round of applause virtually for David. I think, David, you did a great job. Thanks everybody who sent in questions. And next unit will be on disclosure channels. And we will revisit some of these issues actually when we talk about price discovery via different channels. So I think we will stay on this topic for a while. I hope this is of interest to you. And see you back on Wednesday, those of you that take credits, and the others we're going to see in 2 weeks with Beth Blankenspor from Washington University then. So thanks, everybody. Enjoy your Monday. See you around. Cheers. Bye.
Bye.
Bye. Thank you.
Thank you.
Bye.
Bye.
Thanks, everybody, for tuning in. David, thanks for doing this. That was awesome.